Okay, it's 7:30 p.m. sharp. It's Singapore time. Welcome all to this webinar, and good morning, afternoon, and evening to you, depending on where you're located. My name is Tilak Doshi. I am the visiting senior research fellow at the Middle East Institute. For those of you not familiar with the institute, MEI is an autonomous research entity within the National University of Singapore. It looks at and researches the greater Middle East region across the political, economic, and social dimensions, and what it means for Singapore, Southeast Asia, and Asia in general. It is my pleasure and my privilege to moderate today's session, which will look at oil and gas scenarios and prospects for the Gulf states in a net zero by 2050 world. Before I introduce the topic, let me take this time to introduce this excellent panel, which is gathered from around the world. I'll introduce and just briefly give their bios before I hand it off to the first speaker after the introductory remarks to this topic. Dr. Stephen Griffiths is a Senior Vice President, Research and Development, as well as Professor of Practice at the Khalifa University of Science and Technology at the UAE in Abu Dhabi. He is well known in the university and academic environment, but he's also had positions, various positions prior to his current place in Khalifa University. He was at Mazda previously, the UAE's R&D for entity for renewable energy and new technologies in the energy sector. He's been he is advisor to a range of committees, as well as a number of journals in the energy area. I won't go through all of them. Their bios, his bio is provided on our website. And Dr. Griffiths holds a PhD in chemical engineering from MIT and an MBA from the MIT School, Sloan School of Management. Our second speaker for today's session is Dr. Maxime Shankary. He is the director of the Center for Economics and Management of Energy at the French Institute for Petroleum and New Energies in France, obviously. And he was CEO of an energy research firm, which was a consulting company specialized in energy scenarios generation. He has spent time in the Middle East. He was a visiting research fellow at the King Abdullah Petroleum Studies and Research Center in Saudi Arabia, CAPSAC, on natural gas management issues. He was previously also working at Qatar Petroleum from 2010 to 2015. And our last but not least speaker of the day is Mr. Guy Caruso. He is senior advisor in the Center for Strategic and International Studies, CSIS, based in Washington, D.C. From 2002 to 2008, he served as an administrator of the EIA, the Energy Information Administration, the Statistical Energy Agency within the US government, the Department of Energy, that provides independent data, forecast, and analysis of energy. Mr. Caruso, most of us have known him for many years. He brings extensive experience in energy, particularly on topics relating to energy markets, policy, and security. So with that brief introduction to our panel today, let me just start off with some introductory remarks for today's session. On May 18th, the IEA published a landmark report on the pathway to net zero carbon emissions by 2050. Among the many assertions in its 200 plus page report was the rather bombshell call to immediately end investments in oil and gas exploration and development. As you can imagine, there was a significant amount of coverage in the mass media and plenty of reactions on all sides. For example, the Saudi energy minister was widely quoted. Prince Abdul Aziz bin Salman was widely quoted as calling the report comparable to La La Land fiction. He more recently also emphasized that Saudi Arabia will drill to the last hydrocarbon molecule. There were other reports. One day after the IEA report was published, Reuters came out with a report stating that Asia snubs the IEA report, citing some Asian energy officials. OPEC, the OPEC secretariat came out with their statement stating that the report was, if accompanied by actual stop, halting of oil and gas investments, would lead to instability in oil markets. So plenty of reaction all around. Following that report, we've had on July 14th, the EU come out with their raft of energy, climate change focused policies aiming for net zero by 2050. And on July 19th, the US Democrat Party introduced a bill, two of their congressmen introduced a bill on carbon tariffs on imports related to their carbon content in those imports. Of course, the EU package also included the very controversial CBAM, they call it, which is Carbon Border Adjustment Mechanism. Now, of course, it should be noted that a significant number of institutions, global institutions, as well as governments have taken steps to not only support this net zero by 2050, but actually implemented some of the early policies, including EU, of course, the leader in climate change policy, but also the UK and the Biden administration in the US. Multilateral agencies like the IMF, the World Bank are also on board with this. And for many of us, quite worryingly, even central banks will be aligning themselves with this call for net zero by 2050. Now, the Gulf Cooperation Council economies still, as we all know, depend heavily on oil and gas for their national income, for their government budgets, and for social order. They have all, to varying degrees, embarked on economic diversification initiatives over the last several years to reduce such dependency with varying degrees of success. However, the dual shocks of the relatively low oil and gas prices since the mid-2014 and last year's pandemic-induced global economic slowdown has led to very low oil prices, and it has brought the urgency for promoting economic diversification, expanding employment opportunities for its youthful population, and attaining fiscal sustainability. These issues have become even more critical. Of course, today prices have gone up to around the $75 per barrel range. This webinar will seek to explore some of the broad questions facing the GCC economies. How credible is the IEA pathway to net zero by 2050? And how will this affect the price and volume outlook for oil and gas exports from the GCC? By discouraging private sector investments in the oil and gas sector, are the policies promoted by the IEA favorable to the national oil and gas companies of the region, in that they will be able to increase their market shares possibly in global oil and gas markets? And finally, are there specific corporate strategies that the GCC national oil companies will tend to favor if the OECD countries do indeed proceed in adopting policies recommended by the IEA in their net zero scenario, net zero by 2050 scenario? So with those, with that broad series of comments, let me turn the platform over to Steve, our first speaker of the day. Steve.
Thanks very much, Tilak. I'm going to use a few slides in my discussion, so just be kind enough, please, to let me know once you see my slides. Clear?
Yes. Yes.
Okay, great.
Slides.
Thanks very much, Tilak. So I'm going to kick off the presentation of the discussion today by talking about my perspective on many of the topics that Tilak just raised, a very interesting set of questions for GCC countries, given this growing global discussion around net zero. Since I'm the first speaker, before getting into the specifics on how I see the countries in the region here being impacted, I'll talk a little bit about net zero. And to start that discussion, net zero is part of the broader discussion around energy transition. Now, energy transition is something that we're all, I hope we're all very familiar with, because we've been through a few of them. If you look at this slide here, going back to the 1800s, we went through a period where we basically were a society based on renewable energy, although it was traditional biomass. And then with the Industrial Revolution and coal, we grew into a new form of energy. And then finally, in the last many decades, coal and oil and gas and the proliferation of hydrocarbons is a composite have come together to create where we are right now in our energy system. Of course, renewables have grown as well. So we start to see the sustainability come to play for us. So the question that comes now as we get into this discussion of net zero is what's going to happen to 2100, particularly as we start to further push these thoughts about how we are going to limit the emissions from the combustion of fossil fuels, which is tied to, of course, this discussion of climate change. So when we look at this and we start to think further about where we're going with this discussion on net zero, there has been for, excuse me, jump to slide here. There's been for some time a discussion around sustainable development. And so the IEA before the net zero had been pushing forward the sustainable development scenario, which is essentially net zero. It's just achieving net zero emissions by 2070 roughly, which would put us on a trajectory to achieve, if we're lucky, 2 degrees global warming relative to pre-industrial levels. So on average, if we come to a final warming, it'd be about 2 degrees. Now, the recent thinking is that it would be much more important for us to try to limit the global warming to 1.5 degrees, because when you get to 2 degrees, more and more of the climate issues we're already seeing now are just going to be exacerbated. And so now the 2050 dialogue is on the table, and this creates a discussion about how quickly we can move toward mitigating or eliminating emissions, which is going to be the main factor we're focusing on here around the region and oil and gas. And as you can see from the trajectories, it's pretty ambitious to get to net zero, even out to 2030. Within this decade, we'd have to have a massive change in the way that we consume energy. So let's go straight to oil and gas, because that's really the point of the discussion today. There are many net zero scenarios now. We can talk about the IRENA scenario, the IEA scenario. I picked out the BP here to complement the IEA, and they all have a fairly similar trajectory for oil and gas. And I pulled out a few of the comments I thought were common to what these different scenarios are showing us. One is that if we follow a net zero 2050 pathway, we have already hit peak oil, essentially. 100 million barrels would be the max we're going to see, and it would be declining from here fairly rapidly. And by 2050, over the next 3 decades, there'll be a substantial reduction in oil demand and production, around 25 million barrels a day. very, very sharp drop. Natural gas, similar. It's going to be falling off, not so much straight away in the middle of this decade. And then over time, it have slightly a lower reduction in demand, 40, 50% by 2050. The difference in production between the two, on the oil side, as we get into what the scenarios project, the low cost, low carbon producers are going to be the ones that remain. So OPEC is well positioned in the IEA scenario. More than 50% of market share in oil production would come from OPEC countries by 2050. Natural gas, a little bit more diversified, so more players in that arena, particularly as LNG becomes as prominent as pipeline, or more prominent than pipeline production distribution of natural gas. So around oil, things look pretty good if you're a Middle East country, so to speak. And the answer is, well, not really, if you consider the impact that reduced demand will have on price. So even if you're still a producer, as I'll get into shortly, what is the price impact? And the price impact, of course, having impact on revenue. So the GCC, the challenge we're going to face, I think the bottom line is that the economies here, as Tilak already mentioned, are very dependent on oil and gas, particularly oil revenues from export. So if you look at the economic dependence, GDP, although there's been efforts to diversify over the past several years, in the past decade, most of the countries, barring UAE and Bahrain, are fairly dependent economically on the hydrocarbon sector. Exports, heavily dependent on the hydrocarbon sector. Again, the UAE and Bahrain doing a bit better than the others. I think most worryingly, though, is the revenue situation. As many are aware, we don't have a very strong tax regime in the region here, ways to raise government revenues. And so much of the welfare that's been created in the region in the past decade or so, past 2 decades actually, has come from the rents we get from exports, particularly of oil. In Qatar's case, natural gas has been quite helpful. So we're really not in a position where we are ready in the region to jump straight into a world where demand for oil falls precipitously and there is a big price impact. And I'll get to that point shortly. Now, when you look at this, then the question is it inevitable that we're going to net zero? As Tilak said, there's a lot of discussion today, a lot of interest and enthusiasm for this idea. And to answer that question, I go back to the point raised in the introduction from Tilak, that the implication of net zero 2050 is that we have to stop developing any new oil fields immediately. And this is a focus on the oil sector. Natural gas, likewise, you have to stop developing new fields. We're only going to invest in sustaining what's already in place to meet residual demand in the future. Is this a risk to oil supply? Well, in order for us all to work, we would have to have a substantial change in the way in which people consume energy today, now, starting today and going through the next decade and decades to come. And if that all plays out, then by 2030, as the net zero scenario tells us, we'll hit 70 million barrels of oil, then that'll fall much further by 2050 to about 24 million barrels per day. Is that possible? Is that realistic? Does that create risk? And I think the answer to that is yes. So if you look at where many of the projections are to 2030, just given the dynamics amongst the countries that are in this dialogue, not everyone's agreeing to net zero, the possibility of having actually increased demand from what we've seen in the past, not far below 100 million barrels, but actually above 100 million barrels a day of oil demand is there. And so even Wood Mackenzie, just in the past couple of weeks, has said they're foreseeing by 2030 a big gap in the amount of oil production needed, up to 20 million barrels, which means we're going to need high prices to incentivize new development. And hence, we would not be able to dive into the net zero 2050 trajectory straight away. So there is a lot of debate. And so I would not say finally that it's completely out of the question, it's not going to happen, but I'd say it's unlikely given the fact we'd have to start today and potentially have the ramifications that Tilak mentioned about a disrupted oil market and the fallout from that. Now, that said, I do believe that in the future, there will be a net zero. It may not be 2050, it may be 2070, it may be 2090. Someday it's going to happen. That's where we need to go, presuming that we all agree that climate change is largely induced by man-made emissions from the combustion of fossil fuels. So if we do get 2030 or later to a 70 million barrel per day type of oil demand, what would that do to price? And so IEA said 70 million barrels per day at $35 per barrel. If that were to come in 2030, maybe will come later. Sustainable development scenario I talked about previously is more like 2040 for this level of demand. Rethink X raised a lot of interest a few years ago. They talked about shared electric autonomous vehicles eliminating all consumption of gasoline for light duty vehicles. And in their trajectory, oil demand, simply because of that, would fall by 2030 to 7 million barrels per day. And so you see $25 per barrel price of oil. The point being, whether it's 2030, 2040, what have you, or it's $25 or $35 per barrel, you're going to hit many countries with uneconomical reserves. The cash cost of production is below the price of the internationally traded commodity, and so you, or above it, and so you actually would have to stop or shut in your production because you're not going to be able to do that without taking a loss. So whether or not this happens sooner or later, there does need to be strategies, and that's the point of one of the points of the discussion today, is what these strategies can be for countries to deal with this. So look at 4, reducing production costs, maximizing profit, trying to be a player that's in for the long term, moving downstream, probably more so petrochemicals and refining, assuming the demand for light duty vehicle is hit with an internal combustion engine, and then investing into the low carbon transition for sources of energy is another option, and selling your assets, just divesting, is a possibility. I won't talk about that, I'll talk about the first 3. Starting with the perspective of the IOCs, the NOCs, I think the strategy you pick is going to be very context dependent. If you look at the charts, anything that's in blue or light blue is going to be an internationally operating NOC, national oil company, or NOC. And so there's a lot of reserves, oil reserves in particular, as well as gas, that these countries, the national oil companies, are producing within their countries. And so they need to monetize these reserves to the best of their ability. It just makes natural sense to leverage your asset. Some NOCs have other plays. And so we see in the region, Saudi Arabia, the UAE are going heavily downstream, petrochemicals in particular, Qatar, liquefied natural gas. They're not stopping. They're going to be building up more capability for LNG in the future. So I think there is an opportunity here for, at least in that, beyond the current thinking of the companies maybe going in a different direction or eliminating their activities in space, there is an opportunity for this downstream diversification. As far as the continuation of production, so as I said previously, low carbon, low cost is where the continuing producers are going to be in the region. We are the low carbon, low cost producers for the most part, sharing that renown with a few other countries in the world. As you can see here, the most carbon efficient producers, UAE, Qatar, Saudi Arabia is in that club. As far as new projects being developed, which is on the right-hand side of the slides, they're still fairly cost effective. These would be new development projects. This is not the marginal cost of current extraction, which is dollars per barrel. New projects under development, still within the range of $25, $30 per barrel. Here, when the trajectory was looked at, National Resource Governance Institute, they put $40 a barrel because that was a sustainable development scenario price point they were concerned with. The point being that there is a low cost of production in the region. So I think long term, secondarily, we're not just going to move downstream, we can also continue to export hydrocarbons because of the carbon and cost efficiency of what we do here. That said, innovation is required. We do have to continue to lower costs because there are margins to be at least attempted to be achieved. And then we also need to, as I said previously, look after those government revenues, so hydrocarbon dependent. If you look, this is kind of interesting. When I looked very recently, a very recent publication from Atlantic Council, their Oil Market Transition Resilience Index, to reinforce my point and to complement my comments on low cost, low carbon, because of low geopolitical risk amongst oil producing countries, particularly the OPEC countries, Saudi, the UAE, the Gulf countries, Kuwait included, are expected to be increasing their market share in the coming years and decades as we move toward whatever the scenario is. Sustainable development scenario I talked about, production gap report, they're all talking about moving toward much lower levels of oil production in the future, with some of the countries, because of the stability, cost and carbon efficiency, increasing market share. Green arrow being those that are projected to gain share and those expected to lose share because of their instability and or high costs oil production or lack of carbon efficiency on the bottom. The only takeaway I'll say with it really is, I've not brought it previously on this slide, is that I'm not entirely sure that the GCC countries and other countries that have to deal with the fallout of fragile and failing countries not being able to maintain stability because they have no more revenue from exports. I'm not sure if this scenario plays out quite the way we'd hope it to play out, because many of these countries are close to the Gulf. So you'd want to keep that in mind as such considerations are made. And as I start to close out, just last point, where do we go beyond the idea of moving downstream, refining petrochemicals, maintaining production? I think all the NOCs, they do have to prepare for a future in which they will need to do something different, whether it's now or it's 100 years from now. What can you do? And unlike the international companies, getting into the pure energy company concept, producing low carbon electricity or what have you, may not be the core competence. The circular carbon economy was championed last year by the Saudi presidency of G20. I think this is where the NOCs will go. So it's consistent with what they do as a business. We don't try to get rid of carbon. We try to reduce it, of course, and then reuse it, recycle it to the extent possible. This would leverage the ability to take on the technologies that the national companies are dealing with today. Carbon capture, maybe in the future, direct air carbon capture, carbon sequestration and storage, operating through a much lower carbon emissions production set of technologies and scenarios, including reduced methane emissions, would be quite important. Even moving it further downstream into some of the low carbon fuels, which are going to be important in the future. And I'll talk about, just before I close, hydrogen being one of them. I mentioned completely consistent with the circular carbon economy, the green LNG of Qatar. Qatar will be a major LNG producer. They're going to continue to increase their capacity, but they're trying to be sustainable. They're showing that they are using renewable energy to power their operations. CCS, CCUS is part of their idea. And then if you're familiar with LNG, there's an issue around boil off of during shipping and transport, losing some of the energy content of the shipment, and they're also trying to deal with that. So they have a fairly robust strategy for the quote green LNG. So I think the IOCs will go in one direction, NOCs in another, trying to leverage their core competencies. Qatar and the other GCC countries have a great opportunity in low carbon gases. I will mention here in the last point about the hydrogen, this is a big part of the net zero, IEA net zero outlook. And so I do think if the NACs are going to go into a place where it's a core competence that is consistent with what they do as a business, trying to go to this view that hydrogen is going to grow by over 5 times in its current global demand, currently largely being used by refining and ammonia producers, into a much more diversified set of downstream uses. As you see here on the right-hand side, carbon capture from steam methane reforming, autothermal reforming, maybe that's a blue hydrogen, even getting into the turquoise hydrogen with methane pyrolysis, all completely consistent. And so there can be a business for the NOCs in this. As you can see, quite a bit of the gas is going to go toward hydrogen according to the IEA's net zero scenario, even in refining. I mean, if there's one area where it's being considered almost incontrovertible that there will be a role for hydrogen, it's in the production of green hydrogen, blue hydrogen, low carbon hydrogen. It's in the production of low carbon ammonia, and that could be used in shipping. So as you see here, that's a major opportunity, as well as other different products which currently are the focus of refineries. So that's another area in which I think the NOCs are going to move, and they already are. So closing out, transition I think will happen over time. I'm not sure if it's 2050, but it will happen at some point, which means transition is important. Oil producers and exporters in the region, although they may still be producing, the price point is unlikely to be what it is recently and in recent years. And so dealing with revenue reduction is going to be something that has to happen, although they may be able to monetize their natural resources quite well. Moving into this low carbon, low cost production mode to be an ongoing producer is important. Moving downstream is important, petrochemicals to the extent there's demand, and then getting into opportunities like hydrogen, particularly blue hydrogen, I think is quite important. I just put in bold here, hydrogen will not, and I don't see any way it can because of the way in which it's going to be developed and the way it's potentially, if it gets traded, to the extent it's traded, I don't think that's going to be by any means a replacement for the type of revenues that are generated by the NOCs in the Gulf region today in the long term. So there needs to be having that as just one part of a broader strategy. So with that, thank you, and I'll look forward to the discussion that's coming up later.
Thank you. Maxime, can I get you to take over the platform, please?
Okay, but thank you very much, Tilak. Let me also share my screen and a few slides that I prepare. But first, thank you again for your invitation to this webinar and to have the chance to discuss such interesting and exciting, I would say, subject with this audience. So let me share my where it is my slide. Okay, oops. Here. So I think that you should see my slides right now.
Yes.
Is that correct? Okay, perfect.
Okay.
Maybe to just begin with a short presentation of what is IFP School and IFP Énergie Nouvelle or New Energy. So we are a kind of a public research center dedicated to energy and transportation. It means that there is around 1,500 researchers researching all technologies that are for optimizing the current one, as well as creating the new one. And within this institution, there is IFP School, where we are teaching many graduate program, both for our engineering students, but as well as for some economics and management orientated engineers. And it's where I am in this center in energy economics and management. As you asked me, Tilak, to kind of look at this transformation of our economy, of our global economy by 2050, and to look at specifically of this scenario of net zero emission in 30 years, I pick up one of the graph from the report from the International Energy Agency, and that state a bit what will be needed in terms of investment and technology in order to reach this target, net zero emission in 30 years. The first thing that struck me is that, as my colleague Stephen said previously, there will be kind of no new investment in the oil and gas or fossil fuels kind of industries. The second thing is that in the coming few years, in 10 years, 15 years, it means that the electric vehicle become dominant. A few years ago, we had Tony Sebar that were kind of presenting this kind of very disrupting way to look at the industry and how electric vehicle and renewables will take over. And well, now it's the main trend. Even the International Energy Agency is stating that will be in 10 to 15 years if we are to get to this net zero emission goal with a lot of electric vehicles, and that it's becoming dominant. As well, it means that power in building, heating is kind of going for decarbonation. And so it means that in all of that, there is a lot of investment that will need to be done. It's striking to say that, we will have hundreds or thousands of gigawatts of electrolyzer for hydrogen, but as well as a gigawatt of for solar and wind to produce electricity. Another thing is that still in 2050, there will be some fossil fuels being used worldwide, but it will be clean fossil fuels in a sense that their emission will be kind of balanced by CO2 capture and this CO2 will be either stored underground or well, reused in some kind of in some kind of materials, in a kind of you know, it's kind of easy once you've got your CO2 to add some hydrogen to it and then get back into the carbon cycle, I would say, with methanol and many other things like that. So altogether, what is interesting is that most of these technologies exist. Everything that is stated there is already demonstrated. So it means that the main challenge will be, in fact, to scale up all of that in order to reach the size that is needed in order to get to this net zero emission world. So in my talk now that we've got kind of this context, I will focus a bit more on what it means for GCC countries, and especially to look at specific solution regarding this capturing the CO2 from the atmosphere, and how GCC country could leverage, in fact, their storage capabilities and their fossil fuels into a net zero emission world. So the first thing, and of this new world, is that, well, the oil demand is kind of falling down very quickly. And here I put on the slide kind of what is the oil demand according to the International Energy Agency scenario. So from close to 100 million barrels per day in 2019, we will go to around 55 million barrels per day in 2035. And then in 2050, there will be only around 20 to 25 million barrels per day that will be used worldwide. If we look at the kind of cost curve, and I simplify kind of the thing here, I put the cost curve that was, well, that is currently close to something like that. The blue one is kind of the cash cost for oil, and the green one is when you add this all the tax and royalties on the cost of oil, on the cash cost. So what is very interesting when you look at this curve, the first result is really over this long term, over these 30 years, it means that the oil price will settle a lot lower than today. It means that if we are in a world that is using only 20 to 25 million barrels per day, it means that, as you can see on the graph, we are in a world where the cost of producing this oil will be really low. The second thing that is, as a result, of course, it's the GCC country revenue will decrease, in a sense that over this long term, yes, market analysis, we can say that the price of oil will settle at the marginal long-term cost. So it means that it will be, as you can see, something around this, well, if you add some taxes, between $10 to $20 per barrel. Another thing that is very interesting through this analysis, it means that when we look at the curve, in fact, there is some kind of a plateau. and a kind of long plateau up to 40 million barrels per day in terms of production. And that means that there will be a lot of competition between many producers. And that means also that this producer will use the only leverage that they've got, which is their fiscal framework, in order to compete in this environment. In a sense that, sure, a GCC country, we've got a cost advantage in terms of production cost. As we can see, UAE, Iran, or Saudi Arabia are at a very low cash cost. But if we had a few dollars, we will have Russia or Iraq as well. And if we look at the fiscal framework, then we've got many other people that can come into the equation. So it means that there will be a very interesting and interesting competition in this new world with a net zero emission world with such oil demand. Let me go a bit further, just to mean that if we follow what the International Energy Agency is telling us, it means that the revenue for oil country, oil and gas producing economy will fall. And in fact, the revenue is cut in half every decade. Usually this kind of loss of revenue means that there will be more social or political instability within this GCC country, in a sense that the government can't buy the social peace or the peace and harmony in the country. Interestingly also, in this study, we can see that oil and gas producing countries are less impacted in this part, in this analysis. So altogether, there is still a big question: is how could GCC country diversify to replace these lost revenues? And it's a huge assumption that they would like to do that and not just play kind of a financial play as saying, okay, we take as much as we want, we put that in a sovereign fund, and from that, we use all of that as kind of financial revenues. But let's see that they will also go for some industrial solution. And on that, it's kind of a study that we did just last year. And what we did is kind of look at the same kind of hypothesis as the International Energy Agency. In fact, we were kind of reusing the COP21 agreement, stating that the world will go for 2 degrees Celsius by 2100. And so we tried to calculate, to make an economic evaluation of what will that mean. So in order to do that, we had to make a lot of assumptions, and to make this modeling, the model, in fact, we had to say, okay, an international carbon market exists in order for a country to be able to have some strategic possibilities. As to say, should I do more abatement, or should I trade some carbon emission rights? Out of this study, so the first thing that was very interesting is that it was possible to reach this net zero emission as well in 2100. So a bit later than the International Energy Agency, but still. The second thing that was very interesting is that if you add into the mix of the available technology direct air capture, which is a technology that is kind of capturing the CO2 from the atmosphere, and then once you capture it, you can store it underground. as well as the BECCS, which is kind of reusing biomass, burning it, capturing the carbon, and storing the carbon as well underground. So two technologies that where there is a lot of research being done currently, it was possible to reduce significantly the cost for the world of this net zero emission. And when I say significantly, it's really significantly, in a sense that there is over 1% of discounted GDP that will be, in fact, avoided if this technology are used. If we go just a bit further in the analysis, we try to kind of set up a different, I would say, a group of countries in the world in order to see for each of them what would be this the cost for each of the group of country. So we identify the GCC country, and in fact, when you read this yellow line, in fact, how does that read? Is here you've got the cost in order to make the abatement, in order to have the direct air capture implemented, or the CC carbon capture and sequestration. Here will be the term of change. So it's mainly the loss of revenue, gain or loss of revenues. And here will be the revenues from the emission trading. What's interesting in our calculation is that for GCC country, the first thing is that when they implement direct capture, they will be able to gain revenue by trading their emission rights that they will have generated that way. Of course, I would say if you would like more details, you can go to the article. It's on the web, and you can see exactly how we use the model, what hypothesis assumptions that we had, etc. But the main thing that is interesting here is that this GCC country will have a huge gain if they implement such technologies. And in fact, when we calculated this thing, they will save an order of $2.1 trillion. It's $2,100 billion over the next 80 years, accumulated, of course. So it's a lot, but still manageable. And what I would take out of that, it means that this country need definitively to invest in the feasibility at scale of this direct air capture technology, in a sense that whatever dollar that they will put in the research and development of this technology will have a significant return on investment. So that's the first, I would say, take out from the study. The second one is that GCC countries are historically not really involved in the climate discussion. But when we went through the study, it appears that the rules by which the carbon budget will be shared among the different countries is also a determinant of how much you will be able to save for your country or to not have to pay for your country. And it means that GCC country, and in fact any other oil and gas producing country, need to be proactive to negotiate this COP agreement. And that there is a huge also return on this kind of effort. Of course, in our study, we did not include all the technology with hydrogen, and that will be, in fact, the next domain that will be in our study. We are currently doing it this summer, so it will be by the end of the year where there will be exact number assessment of what could be, in fact, also the impact of hydrogen technologies, including in for GCC country to develop. To conclude my talk, in fact, so when we look at this global model and specifically at GCC country, what strategies they should target, the first thing is catalyze innovation. In a sense that, as you see in this energy transition framework, you need to kind of help innovation, technological innovation to come. And this technological innovation will be selected through kind of a societal acceptance. And so it means that the second strategy that GCC country need to pursue is to establish the societal acceptance of clean usage of fossil fuels. And it's very important, not only in the Middle East, but also in Europe. Currently in Europe, most of the discussion is about no fossil fuels at all. So when people speak about blue hydrogen, so hydrogen coming from natural gas and capturing the CO2 after the steam reforming, it means that, well, there should be no blue hydrogen in Europe. So the second part of the strategy for GCC country is to have this societal acceptance. So that way they can continue to produce, export fossil fuels and use them in different sectors of the industry. And the last one is, as I said, negotiate the pace and rule of global carbon management, in a sense that according to the rules, I would say GCC country can lose their shirt in that. In a sense that if you go for a grandfathering kind of a rule or a population-based rule, GCC country will get nearly no carbon budget. So they need to set up some, to negotiate what should be the correct ruling in order to share this carbon budget worldwide. And I would say that will conclude my talk. Thank you very much for your attention.
Thank you, Maxime. It's actually quite interesting that the two talks by you and by Steve occupy a spectrum. I think Steve's talk was somewhat less less confident that many of these technologies are as readily available. Whereas Maxime, I find your talk a bit more optimistic with respect to the outcome of research and R&D, and that 2050 net zero by 2050 is in fact somewhat more achievable from your talk. At least that's a good spectrum of opinion, I believe. And let us now go to our last speaker, Guy, for this session. Guy, over to you.
Thank you, Tilak, and I also thank Steve and Maxime for such excellent presentations that set the stage for why the IEA net zero emissions analysis is so important for GCC, which has been made clear by both Steve and Maxime. And so I will spend my time more from the Washington, let's say, or US perspective, and clearly, it as everyone who studies this issue is aware, the major shift in administrations from the Trump administration to Biden has clearly been a significant factor in the outlook for whether we can actually achieve this transition to net zero emissions. And I, having spent 8 years at the IEA as some of which as one of the directors, I can certainly understand the perspective that Fatih Birol is coming from in this new report by the IEA that was released a couple months ago. And I, among, as Tilak pointed out in his introduction, there's been a lot of criticism to the things like stopping oil and gas investments almost immediately. And as Maxime pointed out, no new investments beginning in 2021, of course, and Steve said it's unlikely to happen. And I completely agree with both of those points. But the IEA does certainly listen to its members, and in the US is the largest consuming member and the largest consumer to the budget. So I certainly can sympathize with where the IEA is headed in trying to listen to its members. I think the things that immediately come to surface in the Biden administration is that the emphasis in transition away from fossil fuels, and that's clear in everything that has been promulgated by President Biden and his team already, and that includes rejoining the Paris Accords and using the G7 and G20 to try to get our allies and friends on board in moving toward net zero emissions, whether it's 2050 or beyond. I think the main point is the emphasis by President and John Kerry has been, let's do what we can domestically and internationally to promote that. And that includes, very importantly, of course, this issue of capital investment in non-fossil fuels and in demand, in slowing down that, as Maxime's point in his last slides, we're getting demand down dramatically from what everyone was projecting just in recent years. And I think we will see whether that happens or not, but the companies are under a lot of pressure because public sentiment has changed in the United States, and it's being reflected in the political policies, the policies of the Biden, of course, but also, as Tilak mentioned, in the Congress, there's a attempt to pass legislation that's going to impose carbon tariffs on imports of energy based on carbon, similar to the EU CBAM. It could be simply a response to that, but I think it's more part of the larger picture of trying to decarbonize. And I think the Republican Party is not on board yet, so I don't see that legislation actually coming to fruition in terms of signed policy, but that's the direction we're headed. You see in the public sentiments side of things, things like Exxon being forced to take on 3 new board members who are more environmentally oriented, let's say, and that happens in other companies as well. And so companies are clearly under a lot of pressure to reduce investments in fossil fuels, and that's going to continue. We're seeing some practical implications of that already in investments of pension funds. And the other area which Maxime mentioned was technology, and Steve mentioned as well, both with respect to hydrogen and other new technologies that would have to really step up, get anywhere near close to net zero emissions by 2050, even 2070. The budget that Biden submitted for 2022, fiscal 2022, includes a huge increase in our energy R&D that towards the movement away from fossils and towards renewables and hydrogen. Whether that actually occurs or not, there's a huge controversy over whether we can achieve as much as this administration would like through just technology. My experience is that technology cannot be ignored, of course, but it usually takes longer than its promoters say it will. But nevertheless, we have to move in that direction. And then the price of carbon, the policy change, huge policy change would be something that actually imposes a carbon price at the federal level. That still looks like it's not likely to happen because of Republican opposition. And then you have continuing conflict in the US between federal and state policy. States have moved out, of course, much more farther out in towards carbon price, imposing carbon price. And the Trump administration, of course, tried to suppress that, but now Biden administration is supporting it. So I would see that carbon tax unlikely to pass even in the with Biden Biden's administration promoting that. The technology for CCS and direct air capture clearly needs to step up. It's still very expensive, and I don't know that that kind of cost would be acceptable in the current budgetary environment. But it's clearly the way we need to move, and I think transition through the companies are moving in the direction of transition through acquisition in the U.S. We're seeing more acquisition of smaller companies that move towards in the direction of the net zero emissions, but still, again, a long way to go. And capital expenditures on non-fossil fuels are certainly increasing, but not nearly as fast as would be needed to meet the requirements. There was one report that said I believe the IEA that said the IEA goals would require a five-fold increase in efficiency improvements on the demand side, and would require geoengineering as well. And the outlook, I think, for the United States is that there will continue to be oil and gas investments well beyond the 2021 and much farther, so that something like 2050 is far, I think, as has been implied by our previous speakers, unrealistic. But it's the direction we all agree, I think, we're moving in. But we probably need to move. We'll move there with companies being and governments being forced into a more pragmatic solution, which will take longer and require continued investment, so that although the impact on GCC is going to be significant, even in a pragmatic capital investments scenario that I think is more likely, it still will be significant. And I think the GCC and will, I think, serve their purpose more efficiently by looking for pragmatic solutions and working with the developed countries through multilateral institutions or bilaterally to move in that direction. So with those very brief remarks, Tilak, I'm happy to join in on the discussion that I think we still have, yes, a fair amount of time for. Thank you.
Yes, thank you, Guy. And that was an excellent summary following the two speakers, Steve and Maxime. And your comments on the US side of things and how it is seen by government and between parties, as well as between the federal and state levels, is also absolutely essential in understanding how the US will try to influence the direction towards net zero by 2050. Let me start the ball rolling in the Q&A by referring to what is traditionally called the elephant in the room. If you look at data from BP just prior to the onset of the COVID pandemic shutdowns, from 2014 to 2019, in the 5 years, the incremental demand for energy was accounted by the third world, by the non-OECD countries, about 80%. So we are in a situation where somewhat less than 20% of the world, the OECD countries, are determining or are at least trying to convince the rest of the world that their combined destiny should be one in which oil and gas and coal, of course, it goes without saying, should be drastically reduced. Now the question, and I think this question is for all three speakers, would be, given the technology today, just to what extent can you expect the third world, which accounts for the vast majority of incremental demand, going out into the future, where their carbon footprints are a fraction, 1/5 or even less of the OECD countries? Do we actually see a realistic scenario where economic development in the non-OECD countries is being put or at least de-emphasized in order for the use of fossil fuels to be reduced? Now that question, of course, implies a certain assumption of technologies. Of course, in the best of all possible worlds, all these technologies that we're talking about will spring about around the corner, and hence assist not only in cutting down on fossil fuels, but carry on with the legitimate aspirations of 80% of the world's population for a higher standard of living. So on that point, I'll just give you one very striking remark by a senior analyst in JP Morgan. He was talking about CCS in his latest 2021 energy report. And this is an investment bank. They are fairly serious about these things. He said that CCS was an example in which he found the highest ratio in the history of scientific thought, the ratio being in the numerator, the number of scientific studies on CCS, and in the denominator, the actual number of CCS projects that have actually taken off the ground. Forget about being economic. The most recent news has been on Chevron's Gorgon LNG project in Australia, where they have failed in their long thought out plan in capturing a significant amount of that CO2. So, without spending too much of time on this question, for each of the speakers, I would like to see how your view on technology balances with the aspirations of the developing countries with respect to future fossil fuel demand. Perhaps we can go in the same order that we introduced, that I introduced the three speakers. So Steve, maybe you could have a go first.
Sure, it's a very good question, because even when you look in the past week and you look at the split between the developing countries, the developed countries, particularly Europe, so much discussion about this focus on the 1.5 degrees target, the 2 degrees target, and so much disagreement amongst the G20 countries, which are the countries which really have to be accountable for making a net zero target work. India, as you know, a major consumer of energy, a major future producer and current producer of emissions, very much not aligned with moving very, very quickly to a net zero scenario, the 2050. So there are certain issues we're going to find with the countries that need to move quickly, that are developing countries, which are going to cause us challenges. Now, I think in the next decade, what has worked and what can continue to work is technological innovation has allowed us to bring the price of solar and wind energy down very low, and it's competitive. On a purely economic basis, you can now deploy in most locations a solar project or a wind project when the resources are appropriate, and that project can deliver value compared to the available fossil resources. When you look at the issues around trying to supplant post-2050, the technologies which need to be in place in order to make a net zero strategy work, it becomes much more ambitious. So the IEA divided that 2030, 2050 timeframe into one where now the current technologies which are economically viable can be deployed. Many countries can take these up on a marginal basis and they can be successful. Post 2030, when you start to get into the technology we're alluding to, carbon capture, looking at the deployment of hydrogen, trying to get into decarbonization of heavy duty transport, these are going to be more difficult, I think, for the countries to be able to absorb and adopt. Now, that's just on a technical basis. When you start to look at the social and political issues, the countries in which they'll have employment impacts by moving away from, say, coal, that's another whole set of issues that has to be dealt with. We talked about the GCC, but we didn't get into so much about the other countries, Southeast Asia, India, and the like, which are going to have resistance simply because they're going to have new economic scenarios in which they're able to live without having employment dependent on these sectors, which will be replaced and they'll be displaced. So I think the question on technology is probably the next 10 years, we can move ahead with what's in place. Innovation has already happened to allow us to move quickly. Post 2030, we will need to see these countries be able to adopt new technologies, which will be more challenging, I think, to deploy in their context. And that's why you'll see resistance today from the non-OECD countries to go extremely aggressively into a net zero 2050 plan.
Thank you. Maxime, your views, please.
Well, first thing, it will be difficult to go further than what Steve already discussed, but maybe to stress a couple of points more. First thing is typically when you look at the last report from IRENA, from our colleague in Abu Dhabi, and the renewable cost, we can see that in the past decades, the cost of solar, of wind decreased significantly. And we know that when you've got this kind of cost decrease, it means that this technology will be implemented. Here is the main issue for developing country, is will they have enough capital to invest in these new technologies? In a sense that there is a significant investment that need to be done. And to answer this question, in fact, I would say currently, yes, because there is nearly you've got money available at a very low cost internationally. So you can use that in order to invest in these new technologies, in this new investment. But as we will get out of the COVID crisis, and so the cost of capital will increase. And in this case, it will be a huge question mark for the developing country to be able to invest at scale, and I mean at scale in these new technologies. So that's my first point. The second one is, we were talking about the G20 discussions that are currently taking place in Italy. And but I remember 2 years ago, it was in Tokyo, in Japan, and then it was mainly about hydrogen. And from that, this decision, there was hydrogen roadmap everywhere. So now we've got hydrogen roadmap to develop hydrogen everywhere. Last year, it was in Riyadh, and it was about this carbon management and our circular economy for CO2. And again, that was very interesting because it kind of pushed the issue about what do we do with this CO2. And this year, it's it's still a bit of question mark, but mainly it's about the taxation of CO2 emission or something like that. Or I don't know. We will see what will get out, but there is a lot of talk about that. Mr. Perry, for instance, was very talkative about that a few days ago. So it means that what it drives me is that, in fact, all of that, we will need to have a price for the CO2, and that nothing will happen if there is not the right price for CO2. Maybe if you remember my presentation in our studies, we were around at $480 per ton by let's say 2050, in order to have this direct air capture technology implementing at a significant scale. So it means that we need to have a very significant price for CO2 emission in order to kick off the investment, in this carbon and capture and sequestration, in hydrogen as well, because hydrogen, it doesn't do anything more than providing heat or power, but without the CO2. So it means that the only thing that is different between fossil fuel is really the cost of the CO2 emitted. So that's, I would say, my second point, meaning that we need to have this a price for CO2 in order to have this implementation. And it was missing, I would say 10 or more than that now. It's 15 years ago, 20 years ago, when there was the first experimentation for the storage of CO2. Especially in Europe, there was huge project and people saying, yeah, we'll do that a lot. And well, it was very nice, but nothing happened. As you say, there was more talking about than a real project in the ground. And why? Because there was no price for the CO2. So there was no profitability that could be made for this kind of investment. And it means that in the future, if we want to go from this kind of public spending to test technology into public subsidies in order to build pilot into the last steps that will be private investment in profitable technology, you need to have a price on carbon, and this price on carbon will be, as I put in the study, several $100 per ton in 10 to 50. After we can discuss that, but in the next few decades, it needs to be above this $250, $300 per ton.
Okay, before I turn to you, Guy, perhaps given your vast experience in DC and with government entities, on this very vital question of R&D, perhaps you could, give us your views on the relative roles about private sector R&D versus government-directed R&D. We've seen the most significant miracle in energy in the last few decades, which is the fracking revolution. which was very much Texans with cowboy boots doing it, not wonks from Washington, D.C. Directing research. So perhaps you could give us your views on the relative roles and just how governments can play a role in promoting private sector-led R&D. Is it merely a case of putting a price on carbon? And if you've got other views on this very important R&D question related to technologies that we're expecting.
Yeah, I think the government-directed energy R&D has been generally not a failure, but inconsistent. And that's the biggest problem, going all the way back to, believe it or not, Nixon's energy independence speech, 74. He proposed a lot of good energy R&D solutions, almost none of which were fully enacted. And partly it's because of the inconsistency. When Reagan came in, there was a complete move away from many of the energy R&D programs that had started under Nixon. So I think the most important thing, and the cooperation between government and private sector, is consistency. And as several of the comments already here is that 1 year it's hydrogen and next year it's a different solution. And natural gas vehicles were the thing under Clinton, and then it became cell fuels under George W. Now electric vehicles are the flavor of choice. So I think the most important thing for government R&D is to be consistent, and unfortunately that is not very compatible with a political system where you have to be reelected every other year. So I think that's a real problem. And one thing we haven't mentioned is nuclear technology, which again has lost favor for a variety of reasons, mainly because of its cost. And it has to play a role, especially if the non-OECD growth that you referred to like 80% of that's in China and India. And I think nuclear will play a role certainly in China and perhaps more so in India. And the bottom line is that I think the capital cost of new technology, excluding, I think wind and solar have done very well in the last decade or so, but other technologies that will be needed to reach net zero emissions by whatever your target year is will need to be less costly, or as Maxime pointed out, a lot of these developing countries will not spend the money to implement that. So I think that's going to be a real challenge. And I'd like to use electric vehicles as an example. There's not a perfect analogy between developed and and less developed countries, but EVs, at least in the U.S., are still a higher income customer base. So if EVs are to reach those targets that are in the IEA report or in other reports, in order to reduce the use of liquid fuels, we're going to have to bring the cost down and the range up. I think when it comes to R&D, a lot more work still needs to be done on batteries and other energy efficiency improvements in the vehicles.
Thank you. Thank you, Guy. I've got a question from a colleague of mine. We used to work together at CAPSAC in Riyadh, and I believe Maxime spent some time there too. My colleague Jitendra Roy has asked a question about the fact related to the transfer of funds by the developed countries to the developing countries as part of the Paris Agreement. As you know, the Paris Agreement from 2015, one of the conditions on which most developing countries agreed to do their best, although they're under no legal requirements to cut back on emissions, but to at least have nationally determined commitments. Part of the deal was that $100 billion a year. Steve, and maybe Maxime, could you have a stab at this question about the expectations that developing countries have with respect to this financial aid from Western countries that to date hasn't been forthcoming? Maybe Steve, you could start off first.
Sure. I mean, it's a great question. And I've thought about this a lot as we watched the whole pandemic unfold, because we continue to talk about how vaccinations are not happening, how support for the developing countries is not happening. And we're in the midst of something so acute and so near term. We still are yet to get the synergy between the developed countries and developing countries to overcome something which is right in front of us. So looking at the long term and now talking about energy technologies and to transfer funds and providing the proper support to help developing countries get positioned for something like net zero 2050. I mean, that needs to be on the table prominently. And there's, every right for the countries now for looking at trying to move very aggressively, very quickly into adopting new technologies. They still have pandemics going. I mean, they're still trying to figure out how they're going to get people employed after the downfall of their economies from a global pandemic, which is not yet mitigated whatsoever in their economies. So I think that there is that need for the developed countries to look holistically at what's coming at us in the future. We talk a minute about energy here today. We're talking about the potential or the need for transferring funds so that technology can be adopted within the countries, which are going to be the driving forces for energy use in the coming years. I think, to be quite honest, it's a dialogue that needs to include not just that, but needs to be looking at health as well, all the different social and political dimensions which can make these countries successful. The US has been stepping up. I mean, I've seen that, and Guy probably has seen quite a bit of this in where he's located, in talking about those transfer funds, so committing more and more, which is good. When we're talking about the billions of dollars versus what these countries, if you look at the totality of the countries outside OECD, are going to need, and just not seeing the numbers add up. So that point you've raised, and from what we've seen from dynamics between the country interactions and the commitment to funds, it's not there yet. And so I think as we talk about reality of transition, this needs to be on the table, is don't forget the countries which are going to be driving the energy demand for the future. Because if we don't have them on board, it's not going to happen. And this funding that we're talking about needs to be at least accelerated to some extent, so we can get some confidence that there is a potential for success in the future. And again, as my point is, 2050 net zero, maybe not going to happen. I hope it happens 2070, 2080, 2090. It's never going to happen if we don't support the countries that need the support to do what they need to do.
Thank you, Steve. Maxime, I will actually would like you to answer a different question that has come up in a number of discussions and debates going on about this entire climate change issue and net zero by 2050. And it relates to you very well, because France has shown us what mass politics and social pressure can do. After all, it was in France that the biggest protests and demonstrations that occurred since 1968 with the Gilets jaunes movement, which was triggered by carbon tax on fuels, on diesel in particular. So from your point of view, do you think that this sheer cost of imposing climate change mandates like this net zero by 2050 will be able to carry a population that is highly sensitive to the demands put on them by by policy elites based in metropolitan areas on paying higher and higher costs for electricity, for gasoline, for diesel, being asked to buy more expensive electric vehicles, being asked to insulate their houses. We've seen poverty grow, energy poverty grow in rich countries like Germany. We've seen blackouts in California. So, in the heartland of France, where protests happen quite regularly, the Young West movement was a major thing. So, what is your view on this pressure of social movements?
Well, there is many points in that. Maybe first with what Jitendra question, and he was as usual right to the core of the issue, which is okay, show me the money. And the money is not there, as Steve said, with this $100 billion that should have been kind of transfer from developed country to less developed country. Well, so it means that, as a guy told us, when it's a government and kind of type of decision, it means that you need to be consistent, and that usually you are not, because you've got some election coming up or some things that will happen and transform what you planned into something else. So that's what I would say for this mechanism that was included in the COP21 and then 22, etc., and discussed further there. But still, when we talk about this energy transition, we are talking about something that is 80 years down the road. So it means many decades. It's long term, meaning that you will need to have some guidance over the long term, and the only players that can provide you this guidance over the long term is the state. That's the only player that is kind of looking at the long-term issues, except if you believe that market will also drive the long-term welfare for everybody. But well, still. To go on your more specifically on this kind of yellow jacket, gilet jaune issue, I think it's when we did the study about modeling the economic cost of this net zero emission with or without direct energy capture or whatever technology portfolio that you want to implement. Altogether, there is a cost, in a sense that we cannot go for a net zero emission world without a significant cost that need to be shared. And that means that if there is a cost, it's how will you share this cost? Well, among countries, like we did in our study, but then when you take one country, it's among the people within this country, how do you share this cost? And there is one of the main challenge for our governments, both the US government, but as well as the French government, it's to make it acceptable by most of the population in a democracy in order to have these people still voting for you. So, which means that it's a large challenge. How I see it in France, in fact, it's we had the opportunity with kind of the nuclear technologies that is being used for close to 80% of the power generated in France, which is not, which is totally decarbonated. So it means that the cost of the CO2 reduction will not be too strong for the citizens, for each of the citizens. That's the power sector. On the transport sector, in fact, the good thing, the way I see that it could go, it's that when you switch to electric vehicles, you are switching also to kind of a computer with wheels, meaning that you are changing totally the good and totally what will be kind of the perception of the cost for the customer. So that way he will pay for the CO2 reduction, but at the same time he will get a lot of new services because of this electric vehicles or autonomous vehicles, this all the services that you can have with the connected vehicles, and that way he will perceive this more value than the CO2 cost that will be associated with the deployment of such a technological device. That's I would say two to pass that I will use for a government in order to try to avoid the kind of riots. Let's be true, it was really that in France that we had for nearly not much in terms of change of the price of gasoline. But so it means that you need to kind of see some perceived value for the customer that will replace this cost of the CO2 reduction, because there will be this cost, and so you need to to share it among the different people of your country or your society.
Thank you, Maxime. We are slightly out of time. We are over time, but I would like to end with one question directed to Guy specifically. And I'm sure he'll be able to enlighten us in a brief manner. We've seen John Kerry jetting around the world, trying to save the world and convincing people that we need to, convincing governments and both developed and developing country governments with respect to climate change and net zero by 2050. What do you specifically think about the kind of discussions he probably has had with the Chinese government? And what do you think are the prospects of the Chinese government actually cooperating with the US with respect to this net zero target, particularly given the fact that China is the largest, by far the largest carbon emitter in the world?
Well, I think clearly he's doing the right thing, because as you pointed out, that's where the growth is going to be. And has to be a substantial reduction in coal. And he's saying to them, your capital investments need to be directed toward the same goal as net zero emissions by 2050. And so I think he'll get lip service and relatively good cooperation. But I think the real problem is going to be this trade issue of where using trade to reduce carbon. The CBAM by the EU, this tariff legislation in the US, I don't think Chinese will go along with that. And so I see the difficulty with Kerry's pitch being in the getting capital investments in non-fossil fuels aligned with a net zero emission scenario. So in the long run, I think it'll fail.
Well, on that note, Guy, thanks for your straightforward frankness.
May I add just something to what Guy said? It's also very interesting to say that if you replace all the power generated by coal by something else, in fact, you will have at least 50% of the net zero emission goal achieved. So it means that replacing coal is really the low-hanging fruit in this thing. And that really, if we do that, after you just need a small direct air capture or whatever.
Yeah.
it will be done.
Yes, yes. Of course, that is the nub of the issue, isn't it? Coal and China have been a policy issue and a political issue that has been almost irresolvable to date. And let's see where we head in the future. So on that note, let me thank my three excellent speakers and panelists. I think we covered a fair bit of ground. The area was wide, but we covered some of the key questions of technology and end of politics and international relations. So I thought it was an excellent discussion. I hope that more people get to watch this session once it's recorded and distributed. So I would like to say good night to or good evening to all other participants in this event. And thank you. And I hope to be in touch with you again. Good night from Singapore.
Thank you.
Thank you.
Au revoir.
Thank you.